Hi everyone. In this video, we are going to talk about the concept of useful information in financial reporting. Now, when you think about accounting, accounting exists in order to record and report financial transactions. And when we talk about the reporting, or sometimes referred to as the communicating, we're talking about reporting and communicating for the parties that will be using that information to make decisions. And therefore, accounting information has to be useful for decision-making purposes. And that's what we mean when we say useful information. We're just saying that whatever information is produced by the accounting system, it must assist in users of financial reporting making decisions based on that information. And of course, to make information useful, there's going to be a set of criteria, or what we call qualities, that enhance or are fundamental to the usefulness of information. And you see those qualities here, 2 fundamental qualities, 5 enhancing qualities, and I'll talk more about those on the next slides. All right, first up, fundamental qualities of useful information. In other words, information cannot be useful without these 2 characteristics. The first one being relevance, the second one being faithful representation. Relevance simply means whatever it is, it's relevant to the business decision. It makes a difference in the business decision. In other words, if somebody is trying to decide what to eat for dinner, telling them the color of the sky is probably not relevant. You did not provide useful information. Telling them what is available to eat for dinner, on the other hand, is relevant. You're giving them useful information. So one fundamental quality, it has to be relevant. And as part of being relevant, the information is going to have both predictive and confirmatory value. In other words, you're giving them information that's going to help make a decision. Going into that decision, users are going to have an expectation of what has happened and what will happen. The information you give them either confirms or contrasts the expectation of what has happened. That's the confirmatory value. And it's going to help them adjust what they expect will happen in the future. That is the predictive value. And then the other thing that makes information relevant is it has to be material. And when we say material, in accounting, what we typically mean by that is it has to be big enough to matter. In other words, if someone is expecting, or let's say an investor is thinking about investing in McDonald's. I use McDonald's as a quick reference often in my videos. If an investor is thinking about investing in McDonald's, you could tell them 2 pieces of financially, hopefully relevant information about McDonald's. One, you could tell them, hey, customer 3,749 ordered an extra fry today when normally they do not. Now, that's financially relevant. That customer spent more money than they normally do. So there was an expectation of what that customer would spend. That expectation has now been contrasted. They spent more, and maybe future expectations need to be revised. All right, that's information 1. Information 2 is, on average, all customers across the globe are spending $5 more per transaction at McDonald's. Same idea, right? It's information that you can compare against what your expectation was, and that will shape your future expectations. The difference is having information about a single customer isn't material. It doesn't matter what that one customer did. Having information about the average of all customers, on the other hand, is material. So for information to be relevant, it's got to make a difference. It's got to have that predictive and confirmatory value, and it definitely has to be large enough to matter. It has to be what we call material. All right, so that's fundamental quality number 1, relevance. Fundamental quality number 2 is called faithful representation, and these 3 things sum it up completely. It has to be complete. In other words, nothing can be left out of the information. It has to be neutral. In other words, it has to be objective. It has to be unbiased. It has to be, this is factually what happened, not here's our fun spin on what happened, right? And it has to be free from material error. If we tell you that across the globe, customers spent $5 more per transaction, It better be that across the globe, customers spent $5 more per transaction. It better not be customers spent 5 cents more per transaction, because that would be a very material difference when you multiply by the number of customers and number of transactions, right? So faithful representation is the other fundamental quality: complete, neutral, free from error. Without these two things, relevance and faithful representation, information simply isn't useful. So these are key. Next up, we have our enhancing qualities of usefulness. Now, the enhancing qualities aren't necessary in the sense of information can be useful without them. However, you're going to see as I talk through them, they are extremely nice to have. And obviously, the more you have these, the more useful the information becomes. First up, comparability. Comparability is essentially the quality where you have the same methods / presentation of information across companies. In other words, when you see the financials of one company, you can compare it to the financials of the next company and the next company and the next company. They're comparable. By having things comparable, it takes the burden off of the investor to adjust the financials to make them comparable, right? Not necessary, but definitely enhances the usefulness of the financial reporting. Consistency, same methods / presentation over time. So within a single company, you're going to produce annual reports for 2016, 17, 18, 19, so forth and so on, right? And investors like to see trends. They'd like to see year-over-year trends. So the more consistent the financial information is, the more comparable those year-over-year numbers become. And so consistency is another one of these enhancing qualities. You don't have to stay consistent from year to year. You can change the way you account for things, but by staying consistent, you're giving more useful information to investors. Next up, verifiability. Verifiability simply means that whatever information is given is supported by evidence. Typically, this is where the auditor role comes in. Auditors are independent parties. They come in, they review the financials, and they say, yep, these financials are good to go, right? They're verifying the financials based on evidence. And so you might say, well, wait, don't you need that? Doesn't it need to be supported by evidence? Well, just because something isn't verifiable doesn't mean it's wrong. It doesn't mean that the company lied about it or made a mistake just because you can't verify it. However, if you can verify it, then that at least gives you comfort that it's correct, that it's not wrong, that no one lied. All right, so again, an enhancing quality of usefulness. Next up is understandability. This simply means that the information needs to be easily interpreted, let's say, by the user. In other words, if the user is a native English speaker and you give them financial statements that are written in Dothrakian from Game of Thrones, that's a problem, right? Because that person is going to have to figure out a way to convert those financials into something understood. And it doesn't just have to be language. It can be language, it can be format, it can be the way things are presented, the currency that things are delivered in, whether it's in a common currency like US dollar or some crazy currency like a cryptocurrency or something. So the more easily interpreted the financials are, the more understandable they are by the end user in their existing form, the better off they are from a usefulness perspective. And finally, there's timeliness. Okay, timeliness simply means that the information is provided when decision relevant. All right. So investors are deciding whether to invest in a company. They want the financial information of the company. It's going to be more useful to get the financial information for the previous year than it is to get the financial information from 5 years ago or 10 years ago, all right? And so that's the idea of timeliness. Now, again, this is one of those where you might say, but don't you need to be timely? Well, not necessarily, because an investor could look at financial information from 2 years ago, 3 years ago, 4 years ago, look at the trends, and have some inclination about what the current year financials should look like. And so even though that information is a little out of date, it still has some usefulness, especially in trend analysis. But of course, the most useful information is going to be current performance, current financials. So the timelier, the better. Again, these 5 enhancing qualities of usefulness, not necessary to make information useful, but definitely makes information more useful the more you have them. That's it for useful information. Hope you found this helpful, and I hope you join me for the next video.